Hi, this is Shamsi. I'm a finance professor, and welcome to the second part of the Overview to Financial Markets video. So, in the last video, we have discussed the different ways to transfer capital within the financial market. We've also known the differences between a financial intermediary and an investment bank, as well as the reasons why we should go to a financial intermediary for our transactions within the financial markets. So today, let's continue where we left off. After that brief backgrounder, we now answer the question, what is a market? So, a market is a venue where goods and services are exchanged. So, it's a typical market. Sa Tagalog, it could be a palengke, a wet market, where people actually go there to buy meat, fish, and vegetables from vendors who have individual stalls. So it is there where the transaction happens between the party who needs the sustenance and the party who actually sells or supplies the sustenance to the buying public. In this regard, a financial market is a place where individuals and organizations wanting to borrow funds are brought together with those having a surplus of funds. So it's not just a wet market, or it's not just food items that has a market. In finance, there is also something that we call a financial market. It is not a physical place, but rather an infrastructure or a system that allows individuals who wants to borrow money and puts them together with people and businesses who has surplus in terms of funds. So, what's the importance of a financial market? So, the financial markets are important because, number one, a well-functioning financial market facilitates the flow of capital from providers of funds to the users of capital. In the previous video, as was mentioned earlier, we have discussed the different ways in which capital can flow. We know about the direct transfers, the transfers through investment banks, and transfers with the help of financial intermediaries. And a well-functioning financial market allows precisely the smooth flow of capital from the providers to the users through any of those means. Second, a well-functioning financial market promotes economic growth because the users can make use of the funds that they have borrowed for business expansion, and the providers of funds are also able to obtain additional income by letting the users borrow their money. So it's a win-win situation. That is why through the financial markets, we also promote economic growth. We add income to the providers of funds through dividends and interest, whereas the borrowers of funds can economically grow in terms of business expansion. Therefore, adding more revenues and even contributing to the gross domestic product of the country through fueling investments in household consumptions. Third, economies with well-developed financial markets perform better than economies with poorly functioning markets. So basically, your financial market is the engine for economic growth, or rather, one of the engines for economic growth. Now that we have defined what a financial market is, let's go through the different types of markets. So you will ask, Miss Jam, meron po ba? Yes, there are different types of financial markets, and we will go through them one by one. So first off, we have the physical assets market. So the physical assets market, from the term itself, is a market where tangible or real assets are being sold. For example, the product or the market rather for agricultural products, a real estate market, a market that sells office supplies or office equipment. That is, those are samples rather of markets that sell physical assets. Second, there's what we call financial assets market. So much like the financial markets, if you go through a financial assets market, you will surely find financial instruments being sold in that market. So what type of financial instruments can be found in the financial assets market? So you can find anything from stocks, bonds, notes, mortgages, and derivatives. Another type of market is what we call a spot market. So when we talk about the spot market, we are talking about a market where the assets are bought or sold for on-the-spot delivery. That being said, you buy the assets now, you get the asset immediately. Or you sell the asset now, you have to give up the asset immediately to the buyer. An example of a spot market is the electricity spot market. There is such a thing as the electricity spot market. This is one of the places or one of the sources of energy of Meralco. So if they actually buy from the electricity spot market, whatever they buy from that particular spot market will be delivered to the Meralco facilities and will be distributed to the households immediately. Whereas the futures market is a little bit different. So from the term itself, future, this is a market in which participants will agree today on a buy or a sell transaction. But the happening or the execution or the delivery of the asset being bought or sold will be done at a future date. So here's an example of a futures market transaction. A farmer is willing to sell his corn crops after 6 months at a price of 120 pesos per kilo. The agreement or the contract, including the selling price, will occur today. So there will be a contract that will be signed today that this particular farmer is willing to give up his corn crops for 120 pesos per kilo to be delivered in 6 months. So the contract is perfected today and the amount is agreed today. But the actual sale transaction, meaning the perfection of the contract through act of delivery, will transpire in the future. So this is the essence of a transaction within the futures market. Next, we have the money markets. Money markets is one of the subtopics in financial markets and institutions. It's actually another type of financial markets where people or interested individuals can find short-term, highly liquid debt securities. When we say short-term, highly liquid securities, it means that this is the market for securities or debt securities, to be specific, that has a maturity date of 1 year or less. So what are the types of financial instruments that are being sold in the money markets? There are a few examples here. As an example, we have treasury bills, because our treasury bills can either be 30-day, 60-day, 90-day, or 180-day treasury bills. The foreign exchange markets, negotiable certificates of deposit, commercial paper, and interbank money markets. And basically, this is to just make a quick cash. So if you're going to, if you want to make a quick income without committing your money in long term, you better go to the financial markets. Second, we have the capital market. What's the difference between the money markets and the capital markets? Capital markets is the market for stocks and intermediate or long-term securities. So basically, the main difference between money markets and capital markets is the maturity of the financial instrument. Money markets will sell highly liquid debt instruments with maturity dates of 1 year or less. If you're looking to invest in something much more long-term, then you go to capital markets, because that's where you will find securities that have a maturity date of 1 year or longer. We also have the primary market. This is the market where private or public corporations raise new capital. In particular, it is in the primary market where first-time issuances of stocks are done. So if it's a first-time offering, it's done in the primary market. So if there is a primary market, for sure, there is a secondary market. So let's compare. What's the secondary market? So the secondary market is a market where previously issued securities are traded. So let's make this as an example. Primary market, if we're talking about vehicles. Primary market, meaning you buy a brand new vehicle, an unused vehicle. Where do you go? You go to the car dealership, or in Tagalog, you go to the casa. If you're gonna be looking into used cars or second-hand vehicles, you go to these auction places, or you go to banks and inquire about repossessed vehicles. By engaging in such second-hand transactions, you are transacting within the secondary market. So in terms of financial instruments, what are the examples of a secondary market? The PSEI is an example of a secondary market because immediately we know that the stocks being traded in PSEI, or in PSE rather, come from a previous owner, and you are just buying the stocks of the previous owner and reselling it to another person. Same is true with NASDAQ or Dow Jones. Those are considered secondary markets. Meron din po tayong tinatawag na public market. Ma'am, is this the same as the public market that we all know? As in, yung palengke po ba ito? Well, in the financial markets, a public market is where standardized contracts are traded in organized exchanges. An example of this is the stock market. So meaning if you are engaging in a transaction in the public markets, pare-pareho po yung contract or pare-pareho yung terms of the transactions, because oftentimes transactions done in the public market are streamlined and in bulk. You do not have time to actually customize terms in a contract or in a transaction that's being done in the public market. That said, on the other hand, a private market is where transactions are negotiated directly between two parties. So as an example, bank loans. So if you already know the terms of a bank loan is unique to each party. It depends on the terms being set by the lender and the borrower. So not all terms are applicable to all kinds of people. The rate of interest will vary depending on the credibility of the person or the individual borrowing. Thus, it also means that the content of the contract may vary if you are engaging in a transaction within the private markets. All right. So I hope that short discussion on the financial markets or the types of financial markets is clear. So let's move forward with one specialized topic that will be discussed further in this class, which is derivatives. So from the term itself, a derivative is a financial instrument or is a financial security whose value is derived from the price of another security. So meaning the value of a derivative is based off the value of something else. Derivatives can generally be used to hedge or shield ourselves from risks. And speculators, if you know about them, these are the people who guess, or as the term suggests, speculates on the movements of future stock prices, interest rates, exchange rates, and commodity prices. So before they can even speculate on this, they will use derivatives to their advantage. So they will use this as an extra level of precaution just in case something goes wrong. So in many cases, transactions will produce higher returns if you guess it right. But of course, if you guess wrong, there will be catastrophic losses. As they say in investments, the higher the risk, the higher the return. So here's some examples of derivative instruments. So just some of the derivative instruments that will be discussed in class is a call option, a put option, and a futures contract. All right. So let's differentiate one from the other. So a call option gives the holder the right to buy the underlying asset at a certain price, meaning you have the right to buy something at a given rate if you hold a call option. Para mas madaling tandaan, remember the term call. When colloquially speaking, when you say call, it means you agree to something, right? So when you have a call option, it gives you the right to buy an underlying asset at a certain price. So what's this price called? It's called the exercise price or the strike price. But there is also a limit as to when you can buy that specific asset at that certain price. So, hindi dahil may call option tayo, we can buy that specific asset anytime. It has to also be done within a specific period of time specified in the option. On the other hand, a put option gives the holder the right to sell the underlying asset at a certain date in the future at a certain price. So basically, a put option is just the reverse of a call option. If you are putting it out there, it means that you have the right to sell the particular asset at a certain price at a certain date in the future. So it has to also be within a specific period. It's not going to be any time or any price. The price is specific. The date is also specific. Third is a futures contract. We have already tackled a few slides ago what a futures contract is. So let's just review this in passing. A futures contract is an agreement to buy or sell a certain commodity or asset at a specific price at a specific time in the future. So, a futures contract is also a form of a derivative. All right. So I hope that this preliminary discussion of derivatives is clear. Now, before we move forward with the more specific topics, let's expand our knowledge further when it comes to financial institutions. So earlier, we've already met a few financial institutions. We know about the investment banks. We know about the financial intermediaries. Let's meet the other financial institutions that are present or that are part of the financial markets. All right. So the first one is an institution that we have met in the last video, otherwise known as the investment banks. So when we talk about investment banks, these are special types of banks or specialized types of banks. These are banks that help companies to raise capital. The investment banks are also known as underwriters. So they are the institutions you go to if you need help raising capital, precisely for the reasons that we have stated in the last lesson, because they have the experts, they have the infrastructure, and you will spend minimal costs rather than going through your phone book or going through your list of prospect borrowers on your own. Second, commercial bank. So, ma'am, may investment bank na nga po. May commercial banks pa rin? Yes, because commercial banks are types of or is a type of financial intermediaries. So, last video, we have mentioned that there are several kinds of financial intermediaries, namely the commercial banks, the insurance companies, the mutual funds, and so much more. So, to distinguish commercial banks from investment banks, commercial banks are the ones or the banks that accept deposits and lend money. So basically, the banks that we know are basically commercial banks. So they are your BDO, PS Bank, Metro Bank, BPI, your Union Bank, Security Bank, and so many other banks. So, there is also what we call a financial services corporation. So, sino to? Who are these financial services corporations? Financial services corporation are large corporations that combine many different financial institutions within a single corporation. So it could mean that this particular corporation combines different services. So as an example, we have Citigroup. So Citigroup is a financial services corporation. It is the mother unit, or it is the owner of Citibank, which is a commercial bank, an investment bank, a securities brokerage organization, and other types of companies that offer other financial services to individuals and businesses. Next, we have the credit unions. The credit unions are cooperative associations that exist primarily for the purpose of giving loans to their members. So in the US, credit unions are fairly common and they oftentimes have commercial banking operations. So some of the examples of a credit union in the States are often these small financial institutions that exist within a specific state. In the Philippines, a credit union is not a usual financial institution. Wala tayong masyadong credit unions in the Philippines. Next, we have life insurance companies. So, as was discussed in the earlier videos, a life insurance company is a type of financial intermediary. So, life insurance companies take savings in the form of premiums and invest these premiums to securities and make payments to the insurers' beneficiaries. So, they primarily exist to safeguard you as a person and take the risk from you. So as an example of life insurance companies, we have plenty of life insurance companies here in the Philippines. One of them is Sun Life, Manulife, Pru Life, Phil-Am Life, Insular Life, at kung ano-ano pa. Next, we have mutual funds. So mutual funds are corporations that accept money from savers and then use the funds to buy stocks, long-term bonds, or short-term securities issued by the businesses or government units. So Sun Life also has mutual funds. You can also invest in mutual funds through your electronic brokerage systems such as COL Financial and First Metro Sec. And later on in our discussions of the financial markets, you will find out what mutual funds can do if you're looking for an investment vehicle. All right. Up next, we have exchange traded funds. These are just like mutual funds, but money received are invested in specific type of securities representing an industry or a market. So mutual funds, there is no specific industry or market being invested in. As long as the money is pulled from several investors and you buy stocks or long-term bonds or short-term securities and whatnot. However, exchange-traded funds are very specific. Specific in terms of securities that they invest in and in the industry or the market that the money is being invested in. All right. Next, we have hedge funds. Hedge funds are also like mutual funds, but these are unregulated and therefore require large minimum investments and are marketed to individuals and institutions with high net worth. Traditionally, hedge funds are used to protect the investors from risk. So, because of the term, di ba? Earlier, we had a few slides ago, we heard of the term hedge when we're talking about derivatives. So hedge funds specifically exist to hedge the investors from large amounts of risks. That is why they also require large amounts of minimum investments rather, and are marketed to specific individuals and institutions that have high net worth, because usually these individuals and institutions are also exposed to a lot of risks, and they need the hedge funds to protect them from these risks that they are facing. Lastly, we have private equity companies. So when we talk about private equity companies, these are organizations which buy and manage entire corporations instead of buying some stocks of those corporations. So basically, instead of this particular company being a stockholder of a chosen firm, they decide to buy the entire corporation, or they decide to take over the corporations by taking control of the majority ownership. So some of the examples are Navigar, Argosy, Primero Partners, and Sierra Madre. All right. So in the next video, we are going to talk more about stock market transactions, what happens in an IPO, and other theories in stock market efficiency. If you haven't yet, feel free to watch part 1 of this discussion. And until then, I will see you on the next one. Bye.